Okay, let's dive into this. If you're an investor who loves income, you know dividends are the name of the game, right? You find a solid company, buy the stock, and get those nice, regular payouts. But what if I told you that the entire calendar, the very rule book that decides who gets paid and when, has just been completely torn up? Seriously. The fundamental rules have shifted, and if you don't know the new ones, you could easily miss out.
I bet this has happened to a few of you. You see that a company's paying a dividend, you jump in and buy the stock, and then nothing. Crickets. You check your account on payment day, and the money just isn't there. It is so frustrating, and almost every single time, it comes down to one little thing.
And that one thing is timing. Getting your dividend payout is literally a race against the clock. And guess what? They just moved the finish line. Just this year, a huge system-wide change in how stock trades are processed has totally upended the dividend schedule. So to make sure you get every penny you're owed, we've got to break down exactly what changed. All right, so to really wrap our heads around what's different now, we first need to hit the rewind button and look at how things used to work for years. The whole system revolves around 4 key dates that every dividend investor needed to know by heart. Okay, here they are: the declaration date, the ex-dividend date, the record date, and the payment date. Under the old system, which was called T+2, these dates were spaced out in a very specific way. It was all designed to give stock trades enough time to officially settle. Let's do a quick breakdown of what each one means. First up, you've got the declaration date. This one's pretty straightforward. It's just the official announcement from a company's board saying, hey, we're going to pay a dividend. They'll tell you the amount, and they'll lay out all the other important dates in the process. Next is the record date. The easiest way to think about this is like the company is taking a snapshot. On this specific day, they look at their books and make a list of every single person who is officially a shareholder. Simple. If your name is on that list, you get the dividend. If it's not, you don't. Now listen up, because this next one, the ex-dividend date, this was the most critical date for investors because it used to take 2 whole business days for a stock trade to officially settle. The stock exchange set the ex-dividend date 1 business day before the record date. See, that little gap gave your stock purchase enough time to get fully processed so your name would actually be on the official list by the record date. The takeaway was this: you had to buy the stock before the ex-dividend date to get that payout. And finally, the payment date. This is the fun part, right? Payday. It's the day the cash actually shows up in your brokerage account. Now, this could be a week, sometimes even a month after the record date, but it's when the company finally sends out the money to everyone on that snapshot list. So that was the old system. For decades, everything ran on that 2-day settlement clock. But in 2024, the financial world decided it was time to hit the fast-forward button, and, well, everything changed. Welcome to the world of T+1 settlement. As of May 2024, all the major North American markets, we're talking the US, Canada, Mexico, they all switched to a new system where stock trades have to be settled in just 1 business day. That 2-day window we just talked about, it got sliced in half. So you might be asking, why go through all this trouble? Why make such a massive change? Well, it all comes down to one word: risk. You see, the longer a trade sits there unsettled, the more time there is for something to go wrong. By shrinking that settlement time, regulators made the whole system safer. It reduces credit and market risks, it makes everything more efficient, and it helps prevent a scary domino effect, where one failed trade could set off a whole chain reaction. It's basically about strengthening the financial plumbing. Okay, a safer financial system is great for everyone, no doubt. But for us, as investors, this big shift to T+1 has completely rewritten the dividend playbook. So let's get to the important part. What does this actually mean for you and your money? This is the key. Under the old T+2 system, remember there was that little 1-day gap between the X date and the record date? Well, with T+1, that gap is gone. Poof, vanished. The settlement window has collapsed, and now the ex-dividend date and the record date happen on the very same day. This changes everything about how you time your purchases because that 1-day buffer you used to rely on is completely gone. So what's the bottom line? Well, as financial planner Brandon Opry puts it, if you want the dividend, you need to be an owner the day before the ex-dividend date. Now, that's always been the golden rule, but here's the thing. Now that the ex-dividend date and record date are the same, your margin for error is literally 0. Let's walk through a quick example to make this crystal clear. Let's say on July 3rd, a company, we'll call it XYZ Co., announces a dividend. They set the record date for July 17th. Okay, so under the new T+1 rules, what's the ex-dividend date? It's also July 17th. This means that to get that dividend payment on August 14th, you must have bought and owned the stock before the market even opens on July 17th. If you buy it on the 17th, I'm sorry, you're too late. You've missed the cutoff. So that's the new main rule, but you know how it is with finance. There's always some fine print. There are a few important exceptions and little wrinkles in the system that can trip you up if you're not paying attention. All right, here are a few things to keep on your radar. First, for really huge special dividends, I'm talking payouts worth more than 25% of the stock's price, the rules are different and the ex-date can get weirdly set after the payment date. Second, if a stock trades in multiple countries, it can get complicated. A stock listed in the US on the T+1 system and, say, the UK, which is still on T+2, might have two different ex-dates. And finally, this is a big one, share lending. If your broker loans out your shares to short sellers, you don't actually get a qualified dividend. You get something called cash in lieu, which gets taxed as regular income, often at a much higher tax rate. It's a tiny detail that can have major tax consequences.
Okay, we've covered a lot. The old rules, the big shift to T+1, the tricky fine print. So what's the one single most important thing you need to walk away with? Let's boil it all down to one new golden rule. Here it is, plain and simple. To get the dividend, you absolutely positively must own the stock before the market opens on the ex-dividend date. With the ex-date and record date happening at the same time now, there is no more buffer, no more wiggle room. You have to make your purchase the day before at the latest. End of story. So there you have it. The dividend calendar has been rewritten. The whole system is faster, it's more efficient, but it also demands more precision from us as investors. That old buffer is gone. So the real question now is, armed with this new knowledge of how the T+1 world works, how are you going to time your next dividend trade?